Hello, my name is Pedro Longart, and I will be talking about the dilemma whether to go for equity, that means issue shares, or debt, that means bank loans, long-term bank loans. And I'm going to give you an example, the example of Tesla. Okay, let's rewind to 2010. Tesla was a rising star in electric vehicles at that time, but it needed serious capital to grow. Instead of taking on debt, Tesla went public, issuing ordinary shares to raise funds. Ordinary shares are also called common stock that represent ownership in a company and come with voting rights. This is different from preference shares, which typically offer fixed dividends but no voting rights. In Tesla's case, ordinary shares were ideal because what it needed was not just money, but committed investors willing to take a risk on long term growth. At this early stage, issuing preference shares, which expect regular payouts, would have conflicted with Tesla's strategy of reinvesting every dollar. Tesla had an initial public offering or IPO that took place in June 2010. An IPO is when a private company first sells shares to the public to raise capital. That's why it's called initial. Tesla issued 13.3 million shares at $17 per share, raising approximately $226 million. The pricing of $17 per share was not random. It was based on investor interest, market conditions, and Tesla's financial forecast. In sterling terms, that was roughly about 11, 12 pounds per share at the time, depending on exchange rates, obviously. Over time, Tesla raised billions more through follow-up equity rounds known as Series A, Series B, Series C, and so on in private markets, and as secondary share offerings once public. Each of these helped fund its ambitious expansion. But Tesla's needs were massive: factories, research, charging networks. The IPO was just the start. Often, equity wasn't enough. The company sometimes considered or used debt, borrowing money from banks or issuing bonds. The name in British English is debentures, but it's normally called, like in the United States, bonds. This choice, equity versus debt, is a fundamental decision in corporate finance. Equity brings in money without needing repayment, but it dilutes ownership. We're going to see what dilution means in a moment. Debt, on the other hand, doesn't affect ownership, but adds pressure through interest and repayment schedules. The right balance is key. That's what is called the gearing ratio or leverage ratio in the US. Each time a company like Tesla issue new shares, it causes dilution. That means the ownership percentage of existing shareholders shrank. For example, Elon Musk's stake was reduced over time, and early investors saw their influence diluted. Obviously, the company grows. Initially, for example, Jeff Bezos' Amazon stake would have been close to, 50, 60, 70%, but the company was very small. Now his stake is about maybe 6%. The company is huge. So he's a multi-billionaire, right? So this is why equity is a trade-off. You raise money, but you give away more control. Remember the famous scene in The Social Network where Eduardo Saverin finds out his shares in Facebook have been drastically reduced? Remember that one? That's dilution in action. New investors coming in and early shareholders losing control. So why didn't Tesla just borrow money instead of diluting control? The answer, equity doesn't need to be repaid. No interest, no monthly bills. And Tesla, like many technological startups, didn't pay dividends either. They reinvested every dollar into growth. While debt is cheaper than equity in theory, thanks to tax deductibility, it adds risk because remember, that's an expense. For a company still proving its business model like Tesla in 2010, equity was safer and aligned with Elon Musk's long-term vision. Investors were betting on him, not short-term profits. This approach is called a dividend hold strategy. What is a digital hold strategy? A digital hold strategy is when they don't pay dividends. This is used by companies like Google, Amazon, and yes, Tesla. Instead of paying cash to shareholders, they reinvest in innovation, in growing the company. It's a bold move, but not all investors like it. Value-focused investors like Warren Buffett, one of the largest investors in the world, prefer companies that generate reliable returns through dividends. It's simple. He says if a company is worth investing, at least they should have some money to give dividends to their shareholders. But for Tesla's early backers, the long-term potential outweighed the lack of an immediate payoff. In short, equity gave Tesla freedom. No repayments meant more flexibility. But equity also brought in strategic investors, people who contributed more than money. In Tesla case, early backers, including tech veterans like Draper Fish, Juverson, BlackRock, and Fidelity Investments. These weren't just investors. They brought networks, industry insights, and credibility that helped Tesla scale. Now let's recap Tesla's equity journey. In 2010, the IPO raised 226 million through ordinary shares. Equity versus debt, that's the dilemma. Growth flexibility, which is that equity gives you, versus control. You lose control. This is a trade-off here. The follow-off shares led to more dilution. More dilution means giving up more control. But Tesla held dividends to fuel expansion. Any profit will come back, will be reinvested. Equity gave freedom, but shifted power, remember, control over time. But on the other hand, these strategic investors helped shape Tesla's trajectory over time. Tesla's story shows the trade-off of equity funding, freedom and growth today versus control and investor returns tomorrow. It's not just about money, it is about vision. Thanks for watching. Stay curious, stay strategic. Thank you very much.